It was February 28th, 2020. The world was just waking up to the word pandemic. The S&P had fallen more than 12% in a week, the fastest drop in history. I was sitting at my desk before the market opened. Screens glowing, red everywhere. The overnight futures had gapped down so far, they were hitting limit-down circuit breakers. My phone was lighting up. Friends, Discord, Twitter, even a few old trading buddies I hadn't heard from in years, all asking the same question, are you getting out? I knew what they wanted to hear. That I was dumping positions. That I was going to cash. That I was cutting risk like a responsible trader. Instead, I bought. Every instinct screamed this was madness. The headlines were predicting global collapse. Twitter was a non-stop panic machine. Every fiber of my body wanted to run. But my system said, buy. The fear readings were off the charts. The exact setup I had spent years preparing for. I remember clicking confirm on that first order, my palms sweating so much the mouse was slipping. I felt sick, lightheaded, even angry at myself. And yet, that was one of the most profitable trades of my career. Not because I predicted the bottom, but because I had the courage to act when the fear was loudest. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here, we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath, clear your mind. For the next few minutes, give your trading psychology your full attention. Because one insight today could change how you trade forever. Years after that trade, I came across a book that put into words what I had been learning the hard way for over a decade. It was Buy the Fear, Sell the Greed, 7 Behavioral Quant Strategies for Traders by Larry Connors. Connors doesn't just talk about fear and greed like they're abstract emotions. He quantifies them, measures them, turns them into a repeatable process. And the moment I read his line, the greater the fear, the greater the mispricing of securities, it hit me. That was exactly what I'd felt in February 2020. The fear wasn't just background noise, it was the edge. This book didn't give me my system, but it gave me a sharper lens to see why my system worked when fear was loudest. The night before that trade, I barely slept. Not because I didn't trust my system, but because I knew what the headlines would look like in the morning. And sure enough, every news site screamed collapse. Markets in freefall. Phrases like unprecedented and historic crash on every banner. I could feel the pressure building. Futures were locked at limit down. The VIX, the so-called fear index, was above 60. A level we hadn't seen since the 2008 financial crisis. The part no one tells you about trading through panic is that it's not just numbers on a screen, it's the physical reaction. Heart rate up, breathing shallow, palms sweating, and that small, insistent voice in your head asking, are you sure you want to do this? I kept coming back to one chart, my fear signal. A simple, systematic trigger I'd tested for years. When it flashed, I was supposed to buy. Not think, not hesitate, just execute. But in moments like that, execution is the hardest thing in the world. Your lizard brain is wired to avoid danger, and everything about that market felt dangerous. I didn't size in all at once. I took the initial position, watched the chaos for a few minutes, then added a second tranche on another wave of selling. It felt like standing in the ocean during a storm, every incoming wave threatening to knock me over. But I reminded myself, storms don't last forever. And when they break, they leave opportunities behind. By the close, my position was already green. Not much, just a few points. But it wasn't about the points. It was about doing what 99% of traders couldn't that day, stepping in when fear was screaming to get out. Over the next 2 weeks, that position became one of the most profitable trades of my career. Not because I nailed the exact bottom, but because I acted when the odds, the real, quantified odds, were in my favor. I've thought about that day a lot since. It reminded me that in trading, the right decision almost never feels good in the moment. It feels uncomfortable. Sometimes it even feels wrong. But fear has a pattern. It builds, it peaks, and eventually it fades. And for those who can step in near the peak, with a plan, not a hunch, the payoff can be extraordinary. What happened that day wasn't luck. It wasn't even about predicting a bottom. It was about recognizing that fear itself, the raw emotion running through every trade, can be measured, anticipated, and used. That's the heart of what we're talking about today. Fear and greed aren't just background noise in the market. They are the market. And if you learn how to read them, if you can systematize your response to them, they can become one of the few consistent edges you'll ever find. Now, before we go further, let me be clear. This isn't financial advice. I'm not telling you to jump into every sell-off. I'm sharing what I've learned in my own trading journey and how understanding the psychology behind fear and greed has changed the way I approach risk, timing, and execution. Fear is the market's clearance sale. But it's not like a calm weekend at the outlet mall. It's like walking into the store while the fire alarms are blaring, sprinklers raining down, and half the customers sprinting for the exits. Most people can't do it. Their instincts say, run, get to safety, wait until it's quiet. But by the time it's quiet, the shelves are empty and the best prices are long gone. The traders who thrive aren't braver than everyone else. They just have a plan for when the alarms go off. Fear isn't just a feeling, it's an asset class. And like any asset, it can be bought and sold. Larry Connors says it plainly in Buy the Fear, Sell the Greed. The greater the fear, the greater the mispricing of securities. That's not philosophy. It's math. When people panic, they stop thinking in probabilities. They trade for survival. They dump positions without looking at value, trend, or even their own rules. And that's when the mispricing happens. Not because the company's worth changed overnight, but because human decision-making collapsed. I've seen this in my own trading. The biggest edges I've captured have come when the fear was so extreme, it was visible not just in the charts, but in the people. Emails from clients begging to liquidate everything. Comment sections full of this time it's different. Media headlines predicting financial Armageddon. When that fear reaches a peak, the market does something interesting. Liquidity dries up. Buyers step aside. And for a short window, sellers will take almost any price just to get out. That's when you want to be ready. Not guessing, not hoping. Ready, with rules in place. I use what I call a fear threshold. It's a specific, tested signal, not just a gut feeling, that tells me fear is likely near exhaustion. Sometimes that's a spike in the VIX. Sometimes it's a combination of price gap, volume surge, and RSI washout. Whatever the method, the principle is the same. You don't buy because it feels right. You buy because the data says the fear is peaking. Now, here's the challenge. That signal almost never feels comfortable in real time. It feels reckless, even irresponsible. And that's why it works. Because 99% of traders can't pull the trigger when the alarms are loudest. If you want to make fear your edge, you have to build a process that overrides your instinct to run. Otherwise, you'll be one more seller feeding the opportunity to someone else. Not all fear is created equal. One of the most useful distinctions Larry Connors makes is between fear in bull markets and fear in bear markets. In bull markets, fear tends to be short-lived. A sudden drop, an ugly headline, a 1 or 2 day sell-off that feels big in the moment, but is quickly reversed. These dips often create some of the most consistent, repeatable edges for traders. The why? Because the underlying trend is still intact. Institutional money is still positioned long. There's still optimism in the background. It's just temporarily drowned out by panic. Bear market fear is different. It's not always irrational. Sometimes it's justified. And when fear is justified, it can last longer, go deeper, and create a lot more volatility. In a bull market, the buyers often return quickly. In a bear market, they may wait, watch, and only step in when there's proof the storm has passed. By that time, the fear edge may already be gone. I learned this distinction the hard way back in 2011 during the European debt crisis. The market was in a downtrend, and I thought I saw a fear spike worth buying. My setup triggered, I got in, and instead of snapping back, the market bled lower for weeks. That trade cost me more than money. It cost me trust in my own discipline for months afterward. Since then, my process has been different. When fear spikes in a bull market, I'm more aggressive. When fear spikes in a bear market, I'm cautious. I size smaller, take profits faster, and assume the recovery will be messier. The key is to understand the context of the fear you're trading. Extreme fear in an uptrend can be a gift. Extreme fear in a downtrend is more like a trap. If you treat them the same, you're not trading the edge, you're gambling on hope. And in markets, hope is not a strategy. One of the biggest misconceptions about market bottoms is that they're created by a sudden rush of eager buyers. That's not how it works. Larry Connors puts it simply, real market bottoms, both short-term and long-term, happen when the last seller sells, not when buyers suddenly decide everything's safe again. I call it the puke point. It's when traders can't take the pain anymore. They hit the sell button not because it's logical, but because they can't stand looking at the position another second. I've watched this play out live more times than I can count. A stock is in freefall. Volume is surging. Every uptick gets crushed by another wave of selling. And then, almost without warning, the selling just stops. It's not that buyers suddenly outnumber sellers. It's that sellers are gone. The scared money has left the building. I remember seeing this during the flash crash of May 6, 2010. The market dropped nearly 1,000 points in minutes. Most traders were frozen, watching in disbelief. But when the selling pressure evaporated, prices started to drift higher, not because there was massive buying, but because there was no one left desperate to sell. This moment is critical for traders who use fear as an edge. If you can recognize when the panic selling has exhausted itself, even if the news is still negative, you can position yourself at prices the market may never offer again. But here's the catch. That moment is never obvious in real time. It feels like stepping into a room that's still full of smoke, not knowing if the fire is truly out. Your instincts will scream that it's too soon. And that's why so few people do it. The traders who understand that bottoms form when selling stops, not when buying explodes, are the ones who can step in early, with controlled risk, and ride the quiet recovery. It's not about being fearless. It's about understanding the real mechanics of panic, and using that knowledge to act when others can't. The biggest mistake I see traders make with fear-based opportunities is thinking they can feel their way through them. They believe experience alone will tell them when to act. The problem is, in the moment, experience often gets hijacked by emotion. That's why Connors' approach resonated with me. In Buy the Fear, Sell the Greed, he doesn't just talk about the psychology, he quantifies it. He uses specific, testable rules that remove the guesswork. When you systematize your edge, you strip away the parts of trading most vulnerable to fear and greed. You're no longer deciding in real time whether the fear is high enough. You're measuring it, you're tracking it, you're waiting for it to hit predefined thresholds you've already tested. For me, that means using a combination of volatility spikes, intraday gap behavior, and volume surges to trigger my fear buys. When those conditions align, I act. No second guessing. No, but this news feels worse than usual. The system either triggers or it doesn't. It's the same on the exit side. I know my targets before I get in. If the market races back quickly, I take profits according to my plan. If it grinds higher slowly, I manage risk the same way every time. Consistency isn't exciting, but it's what keeps me in the game. Systematizing does something else too. It changes the emotional experience of trading. When you know the decision has already been made by your rules, you don't carry the same weight on your shoulders in the moment. The pressure isn't, should I buy? It's the system triggered, execute. And here's the key takeaway. Fear is a powerful edge, but only if you can step in when it's peaking. And you'll only do that consistently if the decision is made before the fear hits. If you're trying to invent your plan during the chaos, you'll almost always talk yourself out of it. Or worse, you'll act impulsively without a true edge. A systematic process turns fear from a threat into an opportunity. And in the long run, that's what separates those who thrive from those who get washed out. Fear is not just a market phenomenon, it's hardwired into human decision-making. Daniel Kahneman and Amos Tversky's landmark research on loss aversion found that, on average, the pain of losing is about twice as powerful as the pleasure of winning. In other words, a $10,000 loss feels like losing $20,000 emotionally. That's why traders so often abandon rules during panic. It's not because they forgot the strategy. It's because their brains are literally overweighting the pain. This is why Connors' point, that the greater the fear, the greater the mispricing, holds up so well historically. When emotions spike, rational valuation takes a back seat. Take March 2009, the bottom of the global financial crisis. The S&P 500 had fallen over 50% from its highs. Media headlines predicted depression-level unemployment. But beneath the surface, selling pressure was exhausting itself. Those who bought in the final weeks of that decline, not because it felt safe, but because fear was peaking, captured one of the strongest bull runs in modern history. Or look at the COVID crash in March 2020. In just 23 trading days, the S&P fell 34%. The VIX hit levels above 80. Liquidity dried up. And then, almost without warning, the selling stopped. Not because good news hit, it hadn't, but because the last wave of panic selling had cleared out the weak hands. The recovery from that point became one of the fastest in history. Even intraday, the same principle holds. During the August 24, 2015 China devaluation panic, many large-cap stocks opened 10% to 15% lower. Within hours, prices had rebounded sharply, not because fundamentals changed, but because sellers had exhausted themselves. These examples aren't cherry-picked miracles. They are repeatable human patterns. When fear overwhelms logic, prices overshoot. When the fear subsides, even slightly, prices revert. And the key here isn't predicting the exact bottom. It's having a measured, systematic way to identify when fear is likely peaking and then acting on it without hesitation. History shows the opportunity is there, but only for those who prepare before the panic hits. If trading fear was easy, everyone would do it. The truth is, most traders miss these opportunities because they fall into the same psychological traps over and over again. 1. Loss aversion and pain. Avoidance. Kahneman and Tversky proved it decades ago. Losses hurt about twice as much as gains feel good. In a fear-driven sell-off, this pain becomes overwhelming. Traders will liquidate positions at the worst possible moment simply to stop feeling the discomfort. They don't realize that the very act of avoiding the pain is what transfers their capital to someone else, the person buying from them. 2. Overconfidence and illusion of control. In the heat of a panic, some traders believe they can time it perfectly. They think they'll somehow know the exact moment to get in, without a system. More often than not, they freeze, second-guess, and watch the market turn without them. Overconfidence tricks them into thinking skill alone can override the sheer unpredictability of fear peaks. 3. Confirmation bias. When fear spikes, the news cycle amplifies it. If you're already nervous, you'll unconsciously seek out articles, posts, and tweets that confirm your worst expectations. Every headline feels like more proof that buying now is insane. You'll ignore data that shows fear is peaking, because your brain is filtering for evidence that supports staying out. I've seen traders talk themselves out of a textbook setup because of these traps. They had the signal, they had the system. But loss aversion told them the pain was too much. Overconfidence whispered they could wait for a better entry, and confirmation bias piled on with a steady feed of fear-fueled headlines. The irony: by the time they felt comfortable buying, the edge was already gone. Avoiding these traps doesn't mean ignoring your emotions, it means recognizing them for what they are and having rules in place so they don't dictate your trades. Understanding fear is one thing, trading it in real time is something else entirely. That's why you need tools, not just ideas. Before you buy into a fearful market, run through a short list, signal triggered. Is your tested setup confirming fear is at or near a peak? Context check. Is this a bull market or bear market? Adjust your size and targets accordingly. Liquidity pulse. Are spreads and volume confirming panic, not just noise? Risk defined. Do you know exactly where you'll exit if wrong? Sizing locked. Is your position small enough that you can sleep at night, even if the market moves against you tomorrow? If you can't check every box, you don't take the trade. When fear spikes, your instincts will try to override your plan. To counter this, take 30 seconds to write down exactly what your emotions are telling you before you execute. It might sound like, "This feels reckless. I'm worried the market will drop another 10%. My gut says stay out." Seeing the emotion on paper creates distance between you and the feeling. It becomes an object you can observe, not a command you have to obey. Over time, you'll notice patterns. You'll see how often those fear-driven urges are wrong. And that's powerful, Because the next time you feel them, you'll remember the system has earned more trust than the emotion. These tools don't make fear disappear. They make it measurable, manageable, and tradable. Let's pause for a moment. Think back to the last time you saw the market in full panic. Maybe it was a headline crash. Maybe it was just a stock you followed tanking on bad news. What did you do? Did you act according to a plan, or did you react according to fear? If you stayed out, was it because the setup wasn't there? Or because you didn't want to feel the discomfort of stepping in? And if you did get in, was it because your rules told you to, or because you guessed that it had to be the bottom? These questions aren't about guilt. They're about clarity. Every trader has those moments they wish they could take back. But the point isn't to erase them, it's to study them, write them down. Ask yourself, what did I feel? What did I miss? What would my system have said? Fear will always be part of the market. The only question is whether it controls you, or you control how you respond to it. If there's one thing I hope you take from this, it's that fear isn't the enemy. Unmeasured fear is. When you can quantify it, prepare for it, and act on it systematically, fear becomes one of the few built-in edges you'll ever have in the market. So here's my challenge to you. In the comments, write down one insight you're taking from this video. Then, share this with a friend who might be struggling to trade through volatility. Because chances are, they're fighting the same emotional battles you are. And if you found value here, like, share, and subscribe so you don't miss the next one. We'll keep breaking down the real mechanics of trading psychology without the hype. Remember, master your mind, master the market, trade with confidence, and live with calm.